All right, let's get right into it. Today, we are going to crack the code on a question that sits at the very heart of business. What is a company really worth? We're going to tackle this just like a top tier consultant would by breaking down the incredibly complex world of corporate valuation into a super clear, actionable framework. Let's dive in. This isn't just some question for a textbook. This is the billion-dollar question. Sometimes it's even the trillion-dollar question that literally moves markets and shapes entire industries. That stock price you see on the screen, that's just the tip of the iceberg. Our mission here is to look right under the surface and really understand what drives a company's true fundamental value. And this right here perfectly sums up the challenge. See, market price is what you pay. Simple enough. But intrinsic value, that's what you actually get. And the whole game, the entire job of a financial analyst is to figure out the difference between those two things. Is the market spot on? Or is there a massive opportunity just hiding in plain sight? Okay, so here's our game plan. First, we'll cover why this all matters. Then, we'll introduce a really powerful framework for thinking about valuation. After that, we'll do a deep dive into the two main approaches, see how they work in the real world, and then we'll wrap up by talking about the blend of art and science that brings it all together. So let's start with the big why. Why does any of this matter? Well, because pretty much every major financial decision, from you buying a single stock to a huge corporation buying another company, it all hinges on finding that gap between price and value. The whole point of valuation is to give us the tools to spot those opportunities. At its core, you've got to remember that valuation is a quantitative process. It's disciplined, we're using hard data, we're using rigorous models to cut through all the market noise and the hype to get to a fair, objective number. It's all about getting past gut feelings and using a structured, analytical approach. Now, to make sense of all the different ways you can value a company, we need a framework. And the best frameworks, as any consultant will tell you, are MECE. That's M-E-C-E. Mutually exclusive and collectively exhaustive. It just means we can sort every single valuation method into one of two buckets. No overlap and nothing gets left out. It's an incredibly powerful way to bring some clarity to a really complex topic. So what are our two paths? Absolute and relative valuation. Think about it like this. With absolute valuation, you're like a building contractor. You're meticulously calculating the cost of every single brick, every window, every nail to figure out what that house is truly worth on its own. But with relative valuation, you're the real estate agent. You're just looking at what all the other similar houses on the street sold for. One looks inward, the other looks outward. Okay, let's double-click on that first path, absolute, or as it's often called, intrinsic valuation. Here, we are trying to figure out what a company is worth based purely on its own merits, completely independent of what the market is screaming about on any given day. It is all about the fundamentals. And the undisputed champion, the heavyweight of absolute valuation, is the discounted cash flow model, or DCF. Now, the concept is actually pretty simple. A dollar today is worth more than a dollar tomorrow, right? But the real magic of a DCF is that it forces you to think deeply and build a story about the future of a business. It's almost like a time machine for money, letting us take all of those future cash flows and see what they're worth in today's dollars. The whole DCF process really boils down to three key steps. First, you have to project the company's future cash flows. And this is where the art comes in, really. Second, you pick a discount rate, which is just a way to account for risk. And finally, you do the math and calculate the present value. That number you end up with, that's your best guess at the company's true intrinsic worth. Now, while DCF is the main event, it's not the only game in town. There are other models in the absolute valuation world. Some focus just on dividends, which is great for those stable, mature companies that pay them out like clockwork. Others look at something called residual income. There's even a super simple asset-based model, but you can probably guess that's not too helpful for a tech company whose biggest assets walk out the door every evening. The key is always picking the right tool for the job. Okay, so we've looked inward with a microscope. Now let's zoom out and grab the telescope. This is relative valuation. It's all about figuring out a company's worth, not in a vacuum, but in the context of its peers, its competitors, and the market as a whole. So why is this approach so popular? Well, as our source material points out, it really comes down to speed and simplicity. It's a much faster way to get a feel for the market and see how a company stacks up. Honestly, for a lot of analysts, this is the very first place they start. And this table really brings the idea to life. So have a look. Let's say your company, that top one, has a price-to-earnings ratio of 15. But then you look across the street at your direct competitors, and whoa, they're trading at 20 and even 22 times their earnings. That's a big gap. So the question is your company some kind of hidden gem, an undervalued bargain? Or is there a really good reason the market is penalizing it? This is the exact kind of puzzle that keeps analysts up at night. The two main tools you're going to find in the relative valuation toolbox are what we call comps and precedents. Comps, like we just saw, is all about comparing your company to its peers right now. Precedents is a bit different. It looks at what similar companies have actually been bought and sold for in the past. And both of these methods use a whole bunch of different multiples to make those comparisons, from the classic PE ratio to more complex stuff like EV to EBITDA. Okay, so we've covered the theory, we've talked about the frameworks, now let's make it concrete. How is all of this stuff actually used in the real world to make these massive, high-stakes decisions? Believe it or not, you see a simple kind of valuation every single day: market capitalization. It's just the number of shares times the price of one share. So 2 million shares at $10 each, that's a $20 million market cap. It's a super quick and easy way to see what the market as a whole thinks a company is worth at any given moment. I mean, valuation is basically the Swiss Army knife of corporate finance. Investors are using it to hunt for bargains. Companies use it to figure out how much to pay in a merger. Startups use it when they're trying to raise money. It even gets used in legal situations like inheritance or when a partner leaves a business. It is absolutely fundamental. All right, time for a little reality check. Because for all the spreadsheets and all the complex models, valuation is not a pure science. It's a craft. It's really this delicate dance between the hard numbers and some very human judgment. And here's the catch. No single model is ever perfect. You can run a DCF and a comps analysis on the exact same company, and I guarantee you will get two different answers. Why? Because every single model is built on a foundation of assumptions. And trust me, a tiny little change in one of those assumptions, like the future growth rate, can have a massive impact on that final valuation number. This quote from our source material just hits the nail on the head. A great analyst knows the goal isn't to find the one right answer. The goal is to understand the range of possible answers and to know which assumptions are driving the whole thing. It's about trading in that illusion of certainty for the real power of informed judgment. So, where does that leave us? It leaves us with a really powerful idea. Valuation is not just about the numbers. It's about the story the numbers tell. The analysis gives you the raw material, the facts, but it's the narrative, the story you build around those facts that gives them meaning. The analysis tells you what a company could be worth, but the story tells you why. And in the world of business, that story is everything.